3 months ago, the consensus was simple. OpenAI owns enterprise, Google owns infrastructure, and everyone else is fighting for scraps. This weekend, that consensus cracked. Anthropic just closed what's being reported as its single biggest commercial win of 2026. And the timing coming right before Q3 budget cycles lock in across Fortune 500 procurement desks is not incidental. The question that should be sitting in your head right now is this. If Anthropic is winning at this scale, what does that tell us about where the actual enterprise AI money is moving and who's quietly losing ground? Let's be precise about what we mean when we say a company lands its biggest win of the year, because in enterprise AI, that phrase carries specific structural weight. This isn't a consumer app getting viral traction. Enterprise deals at the level Anthropic is now competing for typically involve multi-year contracts, deep API integration into mission-critical workflows, and security and compliance vetting that can take 6 to 18 months. When a company the size of Anthropic closes something described in those terms, it means two things happen simultaneously. A large organization's procurement team chose them over OpenAI's GPT-4o infrastructure or Google's Gemini stack, and Anthropic's legal and compliance apparatus proved mature enough to survive enterprise due diligence. That second part is underrated. Most AI startups die in procurement, not in demos. Now here's the data point that gives this context. As of mid-2026, enterprise AI software spending is on track to surpass $200 billion globally this year, according to projections from multiple research firms tracking cloud and AI capex. The fight isn't over who has the best benchmark scores anymore. Those benchmarks have converged enough that they're table stakes. The fight is over trust, reliability, and who a Fortune 500 CTO is willing to put their name behind in a board meeting. Anthropic has spent 2 years positioning Claude around safety and interpretability, and that narrative is now converting into procurement decisions. The actionable insight here is straightforward. When a capital-intensive AI infrastructure player starts winning at the enterprise level, the next signal to watch is whether that win is replicable or a one-off. The Q3 pipeline will tell that story. Here's something that doesn't get said plainly enough. Anthropic, OpenAI, and Google are not competing on the same axis. Most coverage treats this like a horse race. Same track, different horses. That framing is wrong, and it causes investors and operators to misread the signals. OpenAI's competitive advantage is distribution. They got to scale first. They're embedded in Microsoft's enterprise ecosystem, and they have 300 million plus weekly active users giving them a feedback loop that's nearly impossible to replicate. Google's advantage is vertical integration. They own the compute, the cloud, the models, and the distribution through Workspace and Search. Their margin structure on AI is structurally different from everyone else's. Anthropic's advantage, and this is the part that explains this weekend's win, is trust architecture. Their constitutional AI framework, their published safety research, their relatively transparent approach to model alignment. These are not just academic credibility signals. In regulated industries, finance, healthcare, legal, government contracting, they're sales assets. The implication here is that Anthropic isn't trying to beat OpenAI in consumer mindshare or outcompete Google on raw infrastructure. They're carving a wedge through the part of the enterprise market that cannot afford a reputational incident involving their AI vendor. That wedge is narrow, but extremely high value per contract. Think defense-adjacent contractors, Tier 1 financial institutions, healthcare systems operating under HIPAA scrutiny. If Anthropic's biggest 2026 win came from one of those verticals, and the circumstantial evidence points in that direction, then the revenue concentration risk is real, but the margin profile on those deals is exceptional. Not financial advice, but that's the kind of revenue quality that changes how you model a private company's path to a sustainable business. The pecking order isn't OpenAI first, Google second, everyone else. It's becoming OpenAI owns mass market, Google owns infrastructure, Anthropic owns high-trust regulated enterprise. Three separate markets with three different dynamics. Capital follows conviction, and in AI infrastructure, conviction is currently being measured in one metric above all others: enterprise contract velocity. Here's why that matters heading into Q3. The major AI labs are all burning through compute capex at rates that require continuous capital recycling. Anthropic has raised over $7 billion in disclosed funding as of 2026, with Amazon leading a substantial portion of that through AWS. But venture capital and strategic investment at this scale is not charity. It's a bet on whether enterprise revenue can eventually justify the infrastructure cost structure. Every high-value enterprise win Anthropic closes does three things to their capital position. It validates the revenue model in real dollars, not projected ARR. It strengthens their negotiating position with cloud partners like Amazon and Google, both of whom have invested in the company and want those workloads running on their infrastructure. And it gives their fundraising narrative concrete proof points for the next capital raise, which at these burn rates is always closer than it looks. The Q3 signal to watch is not whether Anthropic closes more deals. They will. The signal is whether those deals represent new verticals or deeper penetration in existing ones. Vertical expansion tells you the trust architecture is broadly applicable. Depth in existing verticals tells you retention is strong, but the addressable market has limits. Either story can be compelling, but they lead to very different conclusions about the company's long-term ceiling. For anyone building a thesis around the enterprise AI infrastructure layer, and that layer is where a significant share of the long-term value in this cycle is likely to accrue, Anthropic's trajectory in the second half of 2020 is one of the cleaner signals available. The companies winning procurement battles right now are writing the revenue story that will define valuations in 2027 and beyond. We opened with a cracked consensus. The idea that OpenAI owns enterprise and everyone else is an afterthought. What the evidence shows is more nuanced and more interesting. Anthropic has found a wedge that the other players structurally cannot easily replicate, and they're converting it into real commercial traction at exactly the right point in the budget cycle. The follow-up question worth sitting with, and what we're covering next, is whether Amazon's deep investment in Anthropic creates a conflict of interest with Google's competing stake, and what that tension means for where the real infrastructure leverage sits. Subscribe so you don't miss that one.